Hey there, Nomads. Welcome to another episode of the Nomad Show. So, today we are going to explore the difference between buying and selling option contracts, right? So, before we do so, I think it's important that we sort out what the two types of option contracts are, right? So, we have the call options that gives the buyers of the contracts the right to buy shares at a certain price by a specific date, right? So this is for call options. Then we have the put option contracts that allows the buyers of the contracts to sell 100 shares of the stock of the company shares at a certain price by a certain date. Right? So we have these two type of contracts. The call options will actually move favorably when the prices of the stock or the underlying assets in general is increasing. Whereas for put contracts, it will increase in value when the underlying asset is actually dumping, right? Is going down in the price. So our key topic today will talk on whether we should buy the contracts or we should sell the contracts. So it depends on what type of obligations you want to have and what sort of a trader that you have, right? So personally, I would feel that if you have time to monitor the market daily, right, then personally, my mentor previously been a buyer of the contract only. So with buying, that means they open a position by buying the contract first, right? So once they have that position, then overall they are net buyer. So they could have bought a call contract when they see that the stock is going up in price, or they will buy a put contract, right, when the stock is moving down in price. And then ideally, when the stock has moved up sufficiently, they will close their call position. And when the stock has gone down sufficiently, they will close their put position, right? So that's the ideal case. So in the case when we buy, right, we'll be using whatever capital that we have. Okay, because when we buy a contract, we are spending money, right? So suppose our portfolio has $10,000, then we could spend a portion of it, say $1,000, $2,000, to buy the contract, and we own that contract, right, until the point where we sell it for a profit or even if for losses, right, then we'll get back whatever we have, right, from selling the contract. So that's on one side. Whereas if you are the one selling the contract, right, let's say you're selling a call. Okay, so that means you are now creating an obligation where you promise to sell a hundred shares, right, of the stocks at a certain price by a certain date. So in terms of selling contracts, right, there are two types. One is a covered, one is a naked option. So if you're selling the covered call, for example, then we are promising to sell 100 shares, right, of the stock, 100 shares at a certain price by a certain date. And if we do have the 100 shares, then there is no problem. So we could simply just not do anything and wait for the expiration to come. Okay, so once we sell the contract, we will immediately get a premium, right, which is what the price of the contract is, right? So suppose the buyer bought it for $200, then as the seller, we'll collect $200 upfront. Okay, so that is what we do. We collect the premium. If we have 100 shares, then when the time comes, we can just sell the shares, and we'll simply just have the cash in exchange for the shares. So that is going with the covered route. But conversely, if we go with the naked route, that means we don't have the 100 shares to cover our position, right? We are simply just creating the obligation without being able to fulfill it if the time does come. Then in that case, it depends on your broker, right? So some broker, they do allow this position to be entered. That means from the start, you sell a naked call contract, right, without having the shares to cover the obligation. And depending on the changes in the stock price, you may or may not be forced to top up your account, or you need to liquidate your position. That means you buy back a contract subsequently to cover this position. So in that case, you may face that you have a lot of losses, because with selling a contract, one is that you have unlimited losses, right? Because if you sell a call, and as you remember, a call contracts actually gain in value when the prices are rising, right? The underlying asset prices are rising. So if the prices are rising non-stop, then the call contract will become very valuable, right? It will cost a lot more. And because now we have to buy back the call contract in order to close our position, then we have to spend a lot than whatever premium that we collected in the first place, right? So that is something that we want to avoid. But Because of this, if you are selling a covered call, then it may be less risky, right? Because whether we need to sell the shares or not, right? Depending on whether the shares actually hit the strike price on the expiration date, we may or may not need to sell the shares. But if we do have the shares, then we have nothing to worry, right? It's either we sell the shares and we get cash for it, or we don't and we just keep the premium. So this could be much more of a passive approach because you technically are not monitoring that much, right? We could enter the position on Monday, and on Friday we can open our portfolio and take a look. Right? So suppose it is, let's say in the ideal case, the shares are dumping, right? And the call contract is now almost worthless. We can simply buy back the contract at a very low price to close this obligation. We may open up a new one for the following week, right? So we are collecting the second round of the premium. Okay, so same goes for the put contracts. If we are selling the contracts, then we are creating the obligation to buy 100 shares. So if the shares are going down in value, and of course the put contracts will be worth much more, then subsequently we may need to spend a lot more to buy back this contract, right, in order to close this position. Or you may need to buy 100 shares. Okay, again, if your portfolio has enough cash in order to support the buying of 100 shares, then there is no issue, right? Because you can simply afford to buy the 100 shares and then just hold the shares in your portfolio. Okay, so of course, once you have the shares, then you can change to selling a covered call, right? So it goes, you can just keep changing whatever you sell. With selling, it can be more passive because you may not need to monitor every day. And every day that passes, because of the time decay, the contract would be worth less, right? And there's a chance that you could close the position before expiration to secure the premiums that you have collected, right? And then enter into a second round or third round of selling the contracts. Conversely, if you are buying the contracts, then that means that you may need to monitor more because time decay is against us, right? Every day that passes, and if you're holding on to the contracts, then it's going to decay much more in value, and we are fighting against time to close the position. So with buying, you may need more of an active approach to monitor. With selling, it will be more passive, right? Now, in terms of your cash requirements, buying will require a lower cash amount because whatever you can buy depends on how much you have. So whether you're buying a call contract or a put contract, that costs say $1,000, $2,000. If you have that amount in your portfolio, then you're able to buy that contract, right? So immediately you are able to enter into the position. However, if you want to sell a contract from the start, you may need to have the cash, right? Let's say I want to sell a put contract for Nvidia shares, right? And Nvidia shares, let's say worth about, let's say the strike price is about $120, right? That means we are promising to buy 100 shares at $120 each. So that will tie up $12,000, right, of our capital. So if we don't have a larger portfolio, then we are unable to sell this contract. Right? And some brokers, they may not allow us to sell naked, which means we don't have so much cash. We are unable to sell that position, right, or to enter into that short position. So we are unable to trade in this manner. Okay, because in the first place, unless you top up, right, you don't have cash to support buying these 100 shares, right? And we are not going to let you come to the possibility that you may have to buy the shares but you don't have the cash, right? Or conversely, you don't have the shares but you want to sell a naked call, right? And the broker may not allow us to enter into that position from the start because that would mean that there's a chance, there's a possibility that we have to sell the shares, but we don't have the shares to fulfill the obligation. So that becomes another issue. Okay, so we talked about the requirements of your capital. Buying, you may need less. Selling, you may need a bit more. A more active approach in trading, you can go with the buying route. Whereas if you want something more passive, or you're just collecting the premiums and waiting for it to decay till it becomes worthless, then you can sell the contract. Right? That in terms of time decay, it is working against the buyer because every day that passes, the contract will be worth less, and every day that passes, because the contracts are worth less, the option seller will be able to retain more of their profits. So it's there's no right or wrong. There's no better or worse method or which way to trade. But it's simply more of a preference and looking at whether we can afford to monitor every day, to look at the news, look at what's happening in the markets, and also whether we want to monitor every day, right? Or we have the time to do so. And also looking at whether we want something more risky, right? Because with selling contracts, your risk is actually unlimited, right? Because the premiums that you can collect is whatever gain that you have, whatever profits that you can make, right? So from the start, say we collect $200 as premium, the maximum profit that we can go is this $200, right? You will not exceed that unless you go into a second round or third round of selling the contracts. But within this round, the maximum profit is capped. Whereas if the contract is now going against us, right? Suppose we sell the shares, suppose we sell the put contracts, and then the shares are dropping a lot aggressively, right? And we are trying to buy back the contract in order to close the position to have no more obligation, then we find that we are in the position where we have to spend more and more to buy back the contract, right? Because our losses in that sense will become unlimited. Same thing goes for the call contracts. If it's the share price is rising non-stop, then we are spending more and more to buy back the contract to close the position. So in that case, our losses are unlimited and our profits are capped, right? And then conversely, if you are buying the contract to start the position, then the more that the more that the stock is in your favor, the more profits that you can make, right? It could be 100%, 200%, or a few thousand% profits. It could happen, right? Although it may be rare, it could happen. So that is a possibility. And also the losses that you have will be kept, right? If I spend $600 to buy this contract, then the maximum losses that I have with this position will be the $600 that I spend, right? It will not go beyond that. So in this case, from this perspective, risk management may be easier, right? Or it may be less risk if you buy the contract rather than you sell the contract from the start, right? Because buying is going to cap your risk, whereas if you sell, then your risk becomes unlimited. Okay, so these are some points that we have summarized and present today for this episode of the podcast. Right, so hope you guys actually learned something. So see you guys in the next episode. Goodbye.